The real estate sector is widely recognized as a promising field, offering attractive opportunities for profit and asset security. However, at the same time, it presents intrinsic challenges that vary according to tax structure, technical knowledge, and specific market conditions at any given time. In this text, we aim to explore the reasons why the real estate sector, despite its relevance and appeal, may not be a strategic choice for all types of investors. Our analysis covers everything from pricing dynamics and moments of chaos in financing to tax limitations and the lack of competitive advantages for certain players in the sector. From this reflection, we emphasize the elements that make real estate investment suitable only in well-structured scenarios and for specific investor profiles. Charlie and I have considerable experience when it comes to evaluating the real estate market. Charlie, in particular, took his first steps into the business world by accumulating initial capital through investments in this sector. This hands-on experience, combined with decades of observation, has provided us with a broad understanding of how the real estate market operates and evolves over time. One point I find important to emphasize is that, unlike standardized commodities, real estate has unique and specific characteristics. Despite this, I believe that in most cases, properties tend to be priced relatively accurately, especially when it comes to properties that are developed and managed with strict criteria. This market behavior reflects the maturation of the sector, in which transparent and widely available information plays a crucial role in price formation. However, it hasn't always been this way. During periods of instability, such as during the time of the Resolution Trust Corporation, the real estate market experienced a high volume of transactions and a significant lack of clarity. At that time, many property owners held assets they didn't want to retain for various reasons. These sellers often had little or no understanding of the true value of the assets they owned, creating a rare opportunity for more prepared investors to profit from these market distortions. The RTC era was marked by a combination of unusual factors: sellers motivated to quickly dispose of properties, poorly calibrated prices, and a market dynamic that favored those with access to capital and superior knowledge. As a result, some people, including those probably in this room, were able to leverage these conditions to achieve significant returns. However, in normal times, finding substantially underpriced properties is a considerably more difficult task. Today, the scenario is quite different. When we analyze the contemporary real estate market, especially transactions made by real estate investment funds, we see a high degree of transparency and standardization. These funds, which represent a significant portion of the sector, operate based on widely disseminated information, allowing all participants to have a clear view of the expected performance of certain types of properties. For example, markets for Class A buildings located in major urban centers like Chicago are characterized by high levels of competition. Investors, whether institutional or individual, have a detailed understanding of the financial metrics associated with these assets, such as occupancy rates, projected revenues, and operational costs. While they may diverge in certain aspects of projections, market participants generally have a well-informed sense of the intrinsic value of such properties and the income they are capable of generating. Moreover, access to technology and analytical tools has further contributed to enhancing the accuracy of real estate asset evaluations. Sophisticated software, combined with real-time data availability, enables investors and managers to evaluate the risks and opportunities associated with each property with greater clarity. This technological evolution has reduced market inefficiencies, making it rare for properties to be traded at prices significantly below their real value. Despite this, it is important to remember that the most lucrative opportunities in real estate typically arise during moments of chaos or financial instability, when capital flow is severely restricted and market conditions are less predictable. For investors with capital, experience, and agility, these periods represent windows of opportunity that can yield exceptional returns. However, for most market participants, these moments are challenging and require a degree of preparation that not everyone possesses. In short, the real estate sector, while attractive and highly relevant, is not a universally viable choice. It requires not only a deep understanding of market dynamics, but also a favorable tax structure and access to resources that not all investors can leverage. Therefore, while some manage to thrive in this field, Others face significant barriers that make achieving solid and consistent returns more difficult. The truth is that all of us, regardless of our experience or expertise, are prone to making mistakes when facing uncommon, unexpected, or even chaotic events. The real estate market, although widely studied and subject to rigorous analysis, is not immune to misalignments. However, most of the time it is difficult to challenge the conventional wisdom that dominates this sector. This is a deeply analyzed market, widely understood, where information circulates relatively transparently, and prices often reflect the true value of assets accurately. Still, from time to time, notable opportunities arise that challenge this logic. These opportunities, however, do not appear by chance. Almost always, they are catalyzed by some degree of dysfunction or chaos in the real estate financing system. When the flow of capital is drastically restricted or interrupted, the traditional forces that stabilize the market are disorganized, creating price distortions that can open space for attentive and well-prepared investors. These periods, though rare, offer a window of opportunity for those who can identify and act quickly on market anomalies. Understanding this dynamic is crucial for any investor seeking success in the real estate sector, and Charlie and I are fully aware of this. However, it is equally important to recognize a fundamental limitation we face. We have no competitive advantage over investors who specialize in this market. These investors, often with decades of experience, are able to identify nuances and trends that go unnoticed by most. Even if we operated as a partnership and invested exclusively our own capital, we would still be at a disadvantage compared to these professionals. This disadvantage is exacerbated by the tax structure under which we operate. As a corporation taxed under Chapter C of the U.S. Internal Revenue Code, we face an additional layer of corporate taxes between the revenue generated by properties and the profit that could be utilized by the owners. This structure, resulting in what is known as double taxation, significantly undermines the profitability of real estate investments for entities organized in this format. This structural feature makes real estate, by definition, an unattractive choice for companies with our type of tax setup. This becomes even more evident when we consider alternative structures, such as S corporations or partnerships, which offer greater tax efficiency. These structures allow investors to retain a larger portion of net profits, making real estate a much more viable option for those who can operate under these conditions. When we assess our position, combining the tax limitations with the lack of specialized expertise in the sector, it becomes clear why we have devoted so little time and effort to exploring opportunities in the real estate market. Historically, our involvement in the sector has been limited to occasional cases, such as managing or selling surplus properties we acquired incidentally in our operations. Even in these situations, it is fair to acknowledge that our performance has been below expectations. Charlie frequently points out that C corporations are simply not the ideal choice for the real estate market. While there are companies structured this way that operate in the sector, it is undeniable that other organizational forms are much more advantageous. S corporations or partnerships, for example, do not face the additional tax burden that C corporations encounter, and as a result, they are able to generate much higher net returns. Unfortunately, these more efficient structures are not viable for large insurers or large-scale corporations like Walmart, which rely on the specifics of the C corporation model for their operations. This means that these large companies do not face direct competition from alternative structures, such as S corporations or partnerships, regarding tax efficiency. Still, for investors competing directly with these more flexible structures, achieving solid returns in the real estate market is a monumental task. The difference in tax and operational costs creates a significant barrier, limiting the ability to compete on an equal footing. Ultimately, the real estate sector, from our perspective and considering our specific circumstances, is not just an inferior investment choice. It is, in many ways, entirely unfeasible. Our experiences and analyses show that to achieve success in this market, it takes much more than capital or intention. It requires a complex set of factors, including deep expertise, tax flexibility, and favorable market conditions. Since these elements rarely align for us, we prefer to focus our efforts on areas where our competitive advantages and organizational structure allow us to generate more consistent and significant returns. Charlie highlights an important point by stating that C corporations are by no means the ideal choice for real estate investments. While there are companies structured this way operating in the sector, it is clear that there are other organizational structures that offer much more advantageous conditions. S corporations or partnerships, for instance, provide greater flexibility and tax efficiency, allowing investors to retain a larger portion of the profits generated. Unfortunately, these alternatives are not viable for large insurance companies or massive corporations like Walmart, which rely on the specifics of the C corporation model for their operations. For this reason, these large companies do not face direct competition from structures like S corporations or partnerships, which directly impacts the returns on invested capital. However, for investors competing directly with these more efficient entities, achieving significant returns in the real estate sector can be extremely challenging, if not impossible. In summary, the real estate sector, when analyzed from our perspective and taking into account our tax structure, presents challenges that outweigh its potential benefits. Not only is it an inferior investment choice for corporations like ours, but in many aspects, it becomes completely unfeasible. Experience shows that in order to succeed in this market, it takes more than just capital. It requires a combination of expertise, tax flexibility, and favorable market conditions, elements that, in our reality, rarely align. For this reason, we prefer to focus our efforts on sectors where our competitive advantages, expertise, and tax structure allow us to achieve more consistent and meaningful results. In short, the real estate sector, although initially attractive due to its potential for passive income generation and asset appreciation, turns out to be a notoriously complex and challenging field. The idea that investing in real estate is an easy way to generate profits is far from reality. The illusion of ease that often accompanies this view can obscure the intricate realities of the real estate market, which requires not only capital, but also a sophisticated combination of strategic factors, such as a favorable tax structure, deep industry knowledge, and a well-defined competitive approach. Moreover, the real estate market is characterized by a great diversity of factors that directly affect the value of a property, from the local economic context to global investment trends, fluctuations in financing costs, and the supply-demand dynamics in different regions. As discussed throughout this text, the most notable opportunities in real estate typically arise during times of financial chaos, when there is a drastic disruption in capital flow, creating significant price distortions. These opportunities, while potentially lucrative for the few who are prepared to capitalize on them, are rare events that are difficult to predict and require highly specialized skills, as well as immediate access to substantial financial resources, which not all investors have at their disposal. One of the greatest obstacles faced by investors in the real estate sector is related to the tax burden associated with certain forms of business organization. C corporations, for example, face the severe impact of double taxation. In this model, the profits generated by the corporation are taxed once at the company level and again at the shareholder level when the profits are distributed. This process significantly reduces net returns, making real estate investment less attractive for this type of business structure. This structural disadvantage puts these corporations at a clear disadvantage compared to other forms of organization, such as S corporations or partnerships. These alternative structures offer greater tax flexibility, allowing profits to flow directly to owners without the need for an additional layer of taxation. This factor is key in explaining why large corporations, especially those without a specific focus on the real estate sector, struggle to compete effectively with independent investors or entities structured more efficiently, such as partnerships that can maximize return on investment with greater agility. Furthermore, the real estate market is not simply a matter of buying, selling, or renting properties. It requires a deep understanding of a range of factors that are crucial for success in the sector, such as local economic conditions, regulations and public policies governing the sector, macroeconomic trends, and, importantly, consumer and investor behavior. To thrive in this field, it is necessary to understand how each of these variables interacts and affects the profitability of real estate assets. Additionally, the real estate sector is subject to a number of inherent risks, such as fluctuations in interest rates, which directly affect financing capabilities, and changes in zoning laws or building codes, which can substantially alter the feasibility of an investment. The absence of a solid knowledge base in these areas turns the real estate market into a trap of uncertainties, where misjudgments can lead to significant losses. Experience shows that, for those without the specific expertise required, attempting to operate in this market often results in returns below expectations or even substantial losses. For investors with tax limitations and a lack of specialization in the sector, like us, the real estate market becomes even less attractive. The combination of an unfavorable tax structure and the lack of expertise in the sector creates substantial barriers to achieving consistent and sustainable profits. Our previous experience in the real estate sector reinforces this conclusion. Our efforts directed toward this market have proven less productive in terms of return on invested capital. For this reason, instead of allocating resources to a sector that requires such specific and favorable conditions to prosper, we prefer to direct our focus to areas where we have clear competitive advantages, where the tax environment is more favorable, and where the return on invested capital is more predictable. Our experience shows that investment success is much more related to identifying niches where we can apply our expertise and strategic advantages than pursuing saturated and unpredictable markets. It is worth noting that although the real estate market occasionally offers specific opportunities for significant appreciation and exceptional moments of profit, it is, in practice, a sector far more complex and challenging than it may appear at first glance. Success in this market is not just about identifying properties that appreciate, but about a precise alignment of several factors that can be difficult to control or predict. Investors who stand out in this field are typically those who can combine a set of unique conditions: privileged access to market information, deep and ongoing expertise on local and global dynamics, significant capital available to leverage opportunities, and often the ability to act swiftly and decisively during periods of uncertainty and crisis. These moments of crisis, such as economic recessions or sudden drops in capital flow, can create temporary distortions in the market, making it possible to generate significant profits, but only for those who have the capacity to act with speed, discernment, and the resources necessary to seize these opportunities before other investors notice or can act. This perfect alignment of conditions, although possible, is extremely rare and difficult to replicate, especially in such a dynamic and unpredictable market as real estate. Successfully investing in the real estate market requires much more than simply having access to capital. The ability to identify with precision the strategic moments and locations to acquire, develop, or sell properties is an essential requirement. Moreover, the capacity to mitigate the risks involved is equally crucial. The real estate market is subject to a number of external variables, such as changes in fiscal policies, fluctuations in interest rates, economic fluctuations, and even shifts in consumer preferences, which can significantly impact the viability of an investment. Therefore, without a robust set of analytical skills and decision-making abilities, even investors with substantial financial resources can find themselves in disadvantageous situations. Based on this analysis, we conclude that although the real estate market may, in some circumstances, offer highly lucrative opportunities, it does not represent a viable or strategically appropriate choice for all investors, especially those who do not have the perfect alignment of conditions needed to capitalize on its potential. In our specific case, the combination of tax limitations, lack of specialization in the real estate sector, and the unpredictable nature of the market make this option less attractive and feasible. Rather than venturing into a market that requires such a specific combination of factors to become profitable, we have chosen to focus on sectors where we have clear competitive advantages, where the fiscal and regulatory environment is more favorable, and where we can better anticipate financial outcomes. Our focus, therefore, remains on areas where the alignment between strategy, competence, and expected return is more solid and predictable. We firmly believe that true investment success does not simply depend on exploring markets that seem attractive or offer promises of large profits. Instead, success lies in operating within a context where we can leverage our strengths, maximize our resources, and minimize risks. This disciplined, long-term approach reflects our strategic vision, which prioritizes the efficient allocation of resources and the search for investments that are perfectly aligned with our capabilities, objectives, and a safer, more controlled business environment. This strategy allows us not only to preserve capital, but also to ensure that every decision made is informed, calculated, and most importantly, always in tune with the vision of sustainable growth and prosperity that we aim for. By adopting a thoughtful, long-term approach, we are able to navigate the complexities of the market while minimizing risks and maximizing returns. Each step we take is grounded in a thorough understanding of the market dynamics, our strengths, and the external factors that can impact our investments. We place a strong emphasis on flexibility and adaptability, ensuring that our strategy can evolve in response to changing market conditions. This flexibility allows us to seize opportunities when they arise, while remaining disciplined in the face of uncertainty. Moreover, we focus on building a robust foundation of knowledge and expertise across key areas, enabling us to make decisions that are both strategic and effective. Our commitment to sustainable growth means that we prioritize investments that align not just with immediate financial goals, but with long-term value creation and responsible stewardship of resources. We aim to create a balanced portfolio that provides steady, reliable returns while contributing positively to the communities and industries we engage with. This holistic approach ensures that our actions support not only the financial success of our organization, but also broader economic and environmental well-being. In the end, our strategy is not merely about achieving short-term profits, but about creating lasting, meaningful growth. By staying true to our core principles, we are confident that we will continue to build a future where capital is preserved, investments are maximized, and success is measured not just in financial terms, but in the positive impact we have on the world around us.